I'm Claire Perry O'Neill, former UK government minister. Before that, had a career in finance and was proud to be the minister that actually got the Green Finance Institute established with the wonderful late Sir Roger Gifford, realising that this question of how we use finance as the great enabler in the net zero transition, and also frankly come up with some solutions that could benefit the UK financial system, was a theme that it was wonderful to see this grow and develop into the great institution it is today. And we basically have a panel now that I think includes pretty much everybody we need to talk about this transition. So we have an active investor, an index investor, a public company, a regulator and an asset owner joining us remotely. And I think the plan is to take what we've heard in the various conversations. We've heard about the divest, invest, the clash dilemma as it was presented. We've heard about how finance is the great enabler in the process. We've heard about the issue of data complexity and reporting and transparency. And the hope with this conversation is to actually draw on the experts on the panel to tell us what it actually feels like in their institutions and what they think we need to do. I've spent a fair bit of time in the blue zone myself. In fact, I'm the person you can blame or thank for bringing the COP to Glasgow, some say. And is that the conversations you think ought to be happening in there, particularly about how we join up public and private finance to de-risk big infrastructure projects, to crowd in the maximum number of investment, are not happening nearly as much as they should. And it's been a huge tribute to the industry and to Mark Carney and to others that we have managed to build the momentum in that conversation, or almost on the fringe, although we're not really on the fringe. So what I'd like to do with the panel is kick off and basically just ask them to do a 2-minute intro as to who they are, what they do, and how their organisation sees this climate transition. So let me start off with you, John. Tell us a bit about what you're doing.
Thank you, Claire, and thank you to the Green Horizon Summit. I think it's fantastic to be here, some fantastic conversations going on, and really getting into, I suppose, the meat and potatoes of this discussion from a private finance point of view. I'm John Green from 91. We're an active investment manager running portfolios on behalf of our clients as a fiduciary. We are a manager that started as a domestic manager in an emerging market, and I think that gives us a really interesting perspective on this debate. There's been a lot of discussion today about funding the transition in emerging markets. I think what we've heard increasingly loudly through the day is the question of transition, not just of net zero 2050. And I think when it gets to investing in portfolios, thinking actively about how to support the transition is what we try to do as active investment managers. And it's not easy. It's complicated.
Defend that
we've heard a lot about how oil might be and hydrocarbons might be part of the solution, not part of the problem. How do you think about that when you look at portfolios and when you're responsible as a fiduciary to asset owners? But it's very challenging and very energizing, I think, to feel the attention on this matter.
We're right on the cusp of those conversations. Geof, you're a heavy emitting company, as we like to call you, although one with a pretty rapid trajectory. Tell us a bit about your perspective. Tell us a bit about who you are, first of all, and what the company does.
Sure. Thanks, Claire. And again, thanks for having me as well. So Geof, Stapledon Group ESG Officer for BHP, a global mining company. I've been with the company for about 13 years, but before that I actually worked in Australia advising investors on what we now call ESG issues. So I've kind of sat on this engagement discussion from both sides of the table. But yes, BHP, climate change has been a very important issue for us for a very long time. And I'll give you very briefly 4 reasons why that's the case. So first of all, in terms of our operational emissions, or scope 1 and 2, if you've ever seen a picture of those huge mining trucks where the person in front is about a third the height of the wheel, can you imagine driving one of those up a gradient full of ore? How much diesel gets consumed?
That's a gallons per mile type of equation.
There's a lot of diesel and a lot of electricity to run a mine. So scope 1 and 2, 16 million tonnes. So there's a lot of that. Then secondly, we produce, among other things, iron ore and metallurgical coal, which are used to make steel. And steel accounts for about 8% of the world's emissions. So our scope 3 footprint is huge. So we spend a lot of time focusing also these days on our Scope 3 emissions as well. Thirdly, here's the good news. We produce copper and we produce nickel and also a bit of uranium. So these are critical minerals in the energy transition. You know, electrification needs loads of copper. Nickel, people think about lithium going into EV batteries. There's way more nickel that goes into an EV battery than lithium. So that's, you know, we've got a good diversified portfolio in terms of winners in the transition. And then fourthly and finally, I mean, just to give you an example, climate change impacts our infrastructure and operations. So we spent a couple of billion US dollars a few years ago on raising the height of a port facility because of actual increased storm surge levels compared to when the original trestle was constructed. So it's real, it's impacting our operations in that sense. So adaptation, I suppose.
Often the orphan child in the conversation. Great to bring that up. Thank you. John, again, but I don't like to use the word passive investing. You're an index investor.
We're an index investor.
Yeah, I hate passive. It's a bad phrase.
Thank you. So I'm John Galloway. I'm the head of the Global Investment Stewardship Program at Vanguard. And investment stewardship is the mechanism that Vanguard uses to look after the risk to long-term shareholder value on behalf of the 30 million individual investors who've entrusted us with their long-term savings. And we know that climate change is a fundamental material risk to investment returns in the long term. Vanguard's offered its first index fund to individuals 45 years ago. And by design, an index fund holds a broad, diversified sector of the market at low cost. And it holds it for the long term. So a company it will be held by Vanguard for as long as it's in the index. So fundamentally, climate change is a significant risk to those investors. So we use our investment stewardship program to engage with companies like BHP to understand how their board and how their management team is identifying, overseeing, and mitigating those risks over the long term. When we talk about our investment horizon, when we engage with companies, we're not asking about 2 to 3 quarters or 2 to 3 years. We're looking at 2 to 3 decades. And so it's really important that we understand the complexity of the particular company situation, and again, how the board of that company is overseeing the risk and what plans they have in place to mitigate the risk and provide clear disclosure to companies about what they're doing about it to protect long-term shareholder value.
Great. Now, I want to come back to this question of kind of the nuanced conversation about the transition. That's great. Ladies, we're very sorry you can't be with us in quite a sunny day in Glasgow, but great to have you joining us remotely. Rachel, pensions, you're a long-term investor. People talk a lot about wanting to kind of match those long-duration assets we need with your sorts of portfolios. Tell us a bit about yourself and this climate transition from your perspective.
Absolutely, and apologies for not being with you as well. So my name's Rachel Elwell. I'm the CEO of Border to Coast. We are one of the asset pools that have been established in the UK to help the local government pension fund pool their assets. We represent about 11 partner funds with 56 billion assets under management. We strongly believe that climate change is a systemic risk, and it affects all industries, both in terms of the physical risk that we've already heard from, but also in terms of how that's going to impact capital markets as we see the transition to a low-carbon economy. We therefore believe that there are a number of different ways that we need to think about climate risk. First of all, in how we due diligence our investments and the importance of the data being available and the transparency needed for us to be able to assess those investments and the risks to those investments. Secondly, in how we construct our portfolios and how we might decide to deploy the capital that we have to be able to support the transition. We also believe it's vital to be a responsible steward, and that's very much speaking to that engagement that we've already heard about, and also how we vote the shares that we have. And finally, as an asset owner with large mandates to place where we're not managing those assets internally, our ability to engage with the investment industry more generally, to work with asset managers to improve how they are carrying out their jobs, but also regulators, policymakers, data providers, etc.
Brilliant. And I remember the wrestle it was in government to get your pools established. It was always such a no-brainer that you needed to have these pools put into a sort of aggregate responsible management structure, and a huge role to play, certainly in that local transition as well as at a national level. Thank you. And finally, Kate, great to have you here, our sort of representative regulator, if you like. Tell us a bit about your roles and responsibilities.
Well, two up there, but was at the Financial Reporting Council. The FRC is responsible for regulating auditors, accountants, and actuaries in the public interest by setting high standards of corporate governance, reporting, and audit. We're also responsible for the UK Corporate Governance and Stewardship Codes. And the Stewardship Code perhaps is of most interest to this panel because it was refreshed and reset in 2019 and came into a new code at the beginning of 2020, first reporting in 2020. And really, it built on what it really was looking at an extensive consultation to expand beyond just fund managers, but into asset owners and service providers as well. The first applicants to become signatories put in their applications this year. We received 189 of them, and 126 were successful. They can now wear the badge of honour of being a signatory to what's considered to be the gold standard stewardship code. And we are expecting some more applications over the next month or so, and it will be a continuing cycle. It's a high bar for a reason, and listening to not just this panel, but some of the earlier panels, it's because of this systemic risk. And it's not just about what's in the stewardship code, it goes across the corporate reporting that the FRC is responsible for overseeing in its regulatory remit. I think one of the earlier speakers talked about the bean counters. Well, that's definitely on our radar and looking the way in which they're signing off audits of accounts and reports. Stewardship code has to be, you have to apply every year once you become a member if you want to keep up that membership. It was designed to look at the word that we've heard a lot about today, outcomes. I think it does.
Kate, just to be aware, your connection's a little bit stop-start. You may want to kick a child off the Wi-Fi or see if you can rejoin. We can hear you, but we just lost a few of the words at the end. Okay, we'll move on. I think we got a good snapshot on Kate. We do want to come back to you, particularly on that stewardship point. Thank you. So we've got about 25 minutes. We're going to run this session a little bit tight just to try and catch up some time. But everyone mentioned in their remarks that the question about sort of transition, that this is, as much as we crave a sort of one-size-fits-all framework, we know that there are big nuances in the transition. And actually, Geof, if I can come to you first, because you have a kind of multi-stranded approach to your company's story. You've obviously got some great growth opportunities, but you've also got some pretty hefty assets to decarbonise there. Do you think your investors understand that? I haven't looked at your share price. I should have done before I joined. You're probably having the great commodity surge that everybody else is having. But are you finding yourself being kicked out of portfolios simply because of the businesses that you're in?
There's a lot of investors out there, Claire, so it's hard to give a sort of a generalised or one-size-fits-all answer to your question. But there's more pressure these days, and there are people a better placed than myself to talk to this in detail, but there is certainly more pressure to take more of a binary approach, sort of exclusion lists, for example. Sort of, if you're on an exclusion list, it's exactly what it means. You're not supposed to be inside of their portfolios. But happily, certainly virtually all of our larger investors are prepared to engage. And so I'll give you one example of where this is really important. I mentioned we produce iron ore and metallurgical coal, so it goes to steel, very emissions intensive. And we've just recently published something called a Climate Transition Action Plan, and it's full of targets and goals and discussion of how we align our capital expenditure with the goals of the Paris Agreement. We've got a section on just transition, so it's got all of this good stuff. But And it's being put to a vote at our AGMs. We've got 2 AGMs at the moment because we're dual listed. We've had 1 down and we've got 1 to go. And it's a so-called say on climate vote. And so thankfully we're getting strong levels of support, but amongst the naysayers, commonly it's things like, oh, we're disappointed you didn't set a hard target around the Scope 3 steel-related emissions. And so what's going on there, I think, and it's really important to be able to engage, is it's not that simple. We would love to set a hard target around the Scope 3 related to our iron ore and met coal, but we, hand on heart, right here, sitting here today in 2021, do not think it would be responsible to do so. We think we could be accused of corporate greenwash if we were to do that today. The reason is we cannot identify a pathway for the steel sector to get to net zero as things stand today.
With known technology today.
Yeah, it may be that in 3 or 4 years that changes, and we'll continue to focus really heavily on this space and act in partnership with our big steelmaking customers. We've got 4 of these in place at the moment who, between those steelmakers, they account for over 10% of the world's steel. So we'll try really hard. But it's important to talk these things through with investors. Otherwise, you get this sort of, oh, no hard target, therefore we vote against, or therefore you're off the investable universe list, which is I don't think that's a particularly constructive way or helpful way of managing the transition.
And John G, I mean, this is kind of your team's role, right, which is to get in there in these bespoke transitions and kind of kick the tires and ask the right questions. Do you think your asset managers trust the findings, or are they hungry for you to be a little more binary when you come back?
So our investors, ask us, they, as I said, 30 million individuals have entrusted us and they've asked us to invest in an index. We do have some funds that provide a screen for an environmental or social issue, excluding fossil fuels or carbon-intensive industries, for example. But the vast majority of our funds, divestment's not an option because by design we're going to hold the asset. So that's why we engage with our portfolio companies, BHPs, and everyone else regularly, monthly, yearly, to provide our expectations of what we look for in best practice of overseeing risk on behalf of investors. And that comes down to, for us at the highest level, it's 3 things. First, it's a climate competent board, and a board that has a board of directors that has the skills and the experience and the independence to really identify and challenge management about the company's both risks and opportunities related to the transition. Second, we look for the board to evidence strong oversight of the risk, and that the board is actually attentive and protecting shareholder value in the long term. And then third, we ask for robust disclosure, including disclosure of appropriate targets and then progress against those targets. And that's why we stay actively engaged month after month, year after year, to see progress both against our expectations and against those targets, and then we hold boards accountable if they fail to meet those expectations.
And do you make transparent your scoring or your analysis, or is it internal? Because it strikes me that's actually an incredibly helpful benchmark for the world, if you like. I mean,
yes,
it's kind of the holy grail.
I'll say coming out of Paris, we saw in the years since, we've seen helpful kind of coalescing around clear and consistent frameworks like TCFD. And we're really encouraged by the fact that we see portfolio companies, some with our urging, adopting those frameworks. And the more I think we can have robust disclosure, comparable disclosure, so that we can see whether companies are making their own bespoke transition. Again, we don't believe in one-size-fits-all. We are in violent agreement with the idea that a one-size-fits-all approach to climate change isn't appropriate.
And Rachel, you're sitting there. You're obviously looking for the long-term investment. What metrics do you look to the actual company level, or you're looking, I guess, to fund managers to be doing this work on your behalf? Do you see other groups that are trying to do what Vanguard do in terms of the assurance process, that this is a portfolio that has actually been assessed and found to be progressing, or at least there's a way of distinguishing the laggards from the leads?
So we manage our assets internally, and we also place things with the external managers. So that gives us quite an interesting viewpoint to think of it ourselves as well as hold external managers to account. I just echo, I think it's incredibly important that we actually get the data, and that's really dramatically improving in public equities. But there's still a long way to go in terms of private markets and also in emerging markets versus developed markets, for example.
Yeah, and actually, I'm sorry, no, please go ahead. 'Cause I want to bring in John about developing markets, but I sense you hadn't finished there.
No, please go ahead.
Okay, because John, this is a really interesting question for you, which we've discussed, that you are kind of literally in the coalface, let's call it, with some of your investments. We've talked a lot about South Africa. Clearly huge momentum. Everyone's cheering on the South African transition, but that takes investment, that takes capital. Tell us a little bit about how you do this scrutiny.
Yeah, so I think that there's an important perspective to bring into this discussion, because what we're hearing is about the nuances of every specific company's transition plan, understanding those nuances, thinking about them, making a judgment on them, supporting them with capital or not. The challenge we also have is that we have to report portfolio level performance. And we report portfolio level performance to our clients. And the difficulty with representing company level nuances at portfolio level is enormous. In fact, I think there's a collision. And that collision is basically that the de facto reporting mechanism at the moment is carbon intensity in some shape or form. And the de facto target is linear reduction of carbon intensity. Mm-hmm. Now the problem is that linear reduction of carbon intensity can't take account of specific company challenges. It can't take account of developing market issues and challenges around their specific transition. Just to give you an example, if you overweight, if you double weight emerging markets in the global index, you're going to add 10% to your carbon intensity in your portfolio. And so those things are working almost against each other. And I think as a investment management ecosystem, we really have to think about how we solve that problem. Because linear carbon targets, whilst they are good and they get people to crystallize and focus on the issue, they're often driving capital away. Now we see that in emerging markets. So fantastic report delivered by the BlackRock Investment Institute 2 weeks ago on emerging market transition finance. And basically what that report tells us is what we see, which is there's a huge gap in emerging market transition finance. And private capital is not playing a role in plugging that gap. And why is that? Because emerging market investments are inherently carbon intensive. So you have this really big collision. And I think that to think about transition, we have to begin to think about portfolios using this common but differentiated view. How we think about specific sectors, carbon intensive sectors, how we think about particular country investments in terms of their carbon transition plan and their targets needs to be different between other sectors and different countries. And I think that's the step that we need to take, because there's no data that we can use that can tell us for the same company in the same sector, are they on their transition pathway or aren't they? That's about assessment, that's about analysis, and that's about judgment. And that's where we think active management has a really important role to play. So I think it's between us and the fiduciaries that who are our clients, to work on the system about how do we make sure that these measurements don't actually create the wrong behavior.
Wrong incentives.
Because there's quite a lot of that going on at the moment. We've literally experienced in the last month the first termination of an emerging market equity portfolio because of carbon intensity. And so that's really made us
because of divestment from the portfolio.
Yes, because it's too carbon intense at the portfolio at that client's portfolio, aggregated portfolio carbon. How does it reduce? Well, you take your emerging market exposure out, your carbon intensity comes down, you report to your stakeholders. Stakeholders are happy because they see the carbon intensity coming down. And so that works against investment in the transition, because a successful transition is about working with heavy emitters, either countries or companies, to find successful transition, to finance that transition, and to work with them in an engaged way, but also in an analytical and fundamental and active way to allocate capital to the winners. Yep. We think that there's going to be a significant, what we call transition premium in returns in the coming years. The winners, the transition winners, are going to outperform. So if in your sector you're a transition winner, we say in 5 years' time, you're going to significantly outperform those who don't embrace transition. And for us, that's a really good return driver, but it's adding the and, returns and decarbonisation.
And that is, and that is not what we get in our email boxes every day, which is this constant pressure to just dump the assets. We'll talk about divestment in a minute. But I did just want to go back to Kate, because Kate, I was struck that the UK Stewardship Council, which is seen as the kind of gold standard now, code 2020, moved away from policies to look at this whole question of implementation and outcomes. It sounds like that then is, again, building into this narrative. It's not just what the policies say, it's what's actually being done. Why did that change happen, and what do you think the impact might be?
Oh, well, I hope my Wi-Fi and sound works a lot better this time.
Good. Yes, we can hear you well. Thank you.
Great. I mean, I think it was revised because, when I started in asset management way too long ago, let's face it, this type of issue was green or SRI, and it was a fringe kind of part of the portfolio, and if you wanted it, it was there, but it wasn't integrated. I think we revised and the stewardship code to reflect the progress in reporting, the data, but also the demand out there, not just from asset owners, but individual investors, and listening to that in the consultation. It became more and more about, well, everybody says they're about stewardship. Everyone says that they're an ESG friendly manager. How do I know who's doing what and where are the proof points? And so that's why we did look at this whole idea of engagement. And I heard that in the earlier session. But we mean by that is, you kind of have to prove you're doing it, but what are you asking for? And what are the conversations about, and how are they having impact? And that doesn't mean, I think, some of the more brutal things we've heard about, if you don't divest within 3 months, you lose the mandate. It's more about, okay, you're on that transition journey, help us understand it. And then we can say to the regulator, we're having conversations, they're not quite there yet, but we've got faith that they're on that journey and they're doing all they can. But I think if fund managers haven't got that kind of relationship with their investing companies, it's very difficult to prove that you are really going on that engagement that underpins stewardship. And that's when we got the first 189 applicants. Not all of them passed the bar, because some of the stuff they gave the team was, frankly, glossy brochures saying, we are all about stewardship, we are all about ESG investing. But when we dug down into the realities of what they were actually doing, what conversations with whom, it just wasn't there. And I think, we're glad to see it's a badge of honor for fund managers to get the stewardship code signatory status. And that's why we're asking people to reapply every year to make sure that they continue to live up to the high standards of it. But in the other part of the FRC's remit, as I said earlier, and maybe it wasn't well heard, we're looking at this across auditors, accountants, actuaries, in the way that they're looking at the way that companies are reporting, either in their financial statements or in their non-financial narratives, about what they're doing about all the parts of ESG. And obviously climate is a key thing through that.
So it's the ecosystem, which is great, again. So it's not just the fund managers, it's the entire ecosystem. And this is a very encouraging conversation, because this is exactly what we want to happen, rewarding momentum, really understanding the stewardship, having those intelligent conversations. But the truth of it is we all get bombarded with, divest fossil fuels now, right? There's a lot of that going on just across the road. It's not just in the protesters, and there is this sense that somehow, if you just force divestment of fossil fuels, those assets will magically vanish. And of course, we all know that's not true. It's not true from an investment point of view. It's certainly not true from a physical ownership point of view. So, have you had examples of that, and how have you pushed back against that? And do you think we can win that argument?
So, and again, it comes down to what's easy to measure and report. And it's easy to measure and report scope 1 and 2 carbon.
Yeah. Not easy.
Well, it's not easy, it's possible. But then you get into, okay, so how does scope 3 affect the picture? Yes. And for many companies, that's not possible. It's very difficult. And when you combine that now with regulatory pressure, which says, come and tell me how you are delivering a sustainable outcome, then the easiest way to deal with that is to shift to a low carbon portfolio. the easiest way to deal with linear carbon reduction in your portfolio is to shift to a low carbon portfolio.
But that ends
And
up
so what's happening is that divestment is just happening because of portfolio level measures, regulatory oversight that is saying you need to be able to demonstrate. And that collides with the nuances of specific transition. So it's happening. The divestment is happening. But it's not happening for, in many cases, the right reasons.
Right.
It's
And
happening because we can then clean the portfolio rather
Yes,
than the real
than
world.
actually
So you have
clean
this
it.
clash between real world decarbonisation and portfolio decarbonisation. And I think that's the biggest challenge for the investment ecosystem, is how we don't wake up in 5 years' time and say, we've all decarbonised our portfolios, but the world actually hasn't changed.
And those assets have just moved further
And
away
they've
from
moved away,
stewardship,
they've
right?
done it
Because
right.
they've gone
if I
private.
might, I mean,
Please, jump in.
where Vanguard's a proud signatory, accepted signatory of the UK Stewardship Code, and one of the reasons we're proud of that is we think it is important that we demonstrate the outcomes,
Yep.
that we demonstrate that we are working with portfolio companies, that it's not lip service, because we understand the kind of their urge to divest, and it feels like it's a little reductive, but it is an understandable urge. I think we have to do the work to explain how, through active engagement and through the nuanced understanding of each company's own transition plan, and the fact that we hold boards accountable for executing on those plans. That's, I think, part of how we kind of push back on some of that pressure you're describing.
I mean, you end up basically only ever wanting to invest in companies that have no emissions, which is completely counterintuitive to what we're trying to do, which is to align capital to the most rapid
transition,
decarbonisation. And actually, Geof, a question for you. I mean, is your company ever tempted just to go private and say, to hell with all this public reporting stuff? We're just going to work there, do our thing, and of course we're going to be responsible, but we're just not going to deal with all this pressure.
No, I think we'd need John's and a lot of other shareholders' approval to do that. So I don't think our board and management could unilaterally make that decision. I'm probably in their private moments once or twice, some of them may have thought that would be a really nice thing to be able to do.
Stuff.
But what it does do, Claire, I think, is it does at the end of the day cause some assets, in our case some mines, not necessarily from BHP but others, to kind of slip out of publicly listed company hands into private hands, whether it's sovereign owned or private equity or whatever, and you don't get the same level of scrutiny and robust debate once things are out of the publicly listed space. So is that a good outcome? I suspect it's not a good outcome. So there's this fine balance between, as I said, I've sort of always worked inside of a listed public company. I used to work on the investor side of this. So I completely support robust, forthright engagement and pushing listed public companies, but not. It's a fine balance between pushing and urging them to take these issues more and more seriously and strive to set tougher targets, but not so to the extent that you've gone so far that assets sort of migrate out of the listed public
And
space.
one of the facts that we never talk is 65% of current oil and gas production is in the hand of the state-owned enterprises, and some of those countries are going to just keep pumping till the last drop, right? Whether or not there is any issue over stewardship and emissions reduction, emissions transparency. So it's a very good point. I wanted to turn a little bit to, you made a great point, John, about trying to find public-private ways to drive some of these transitions. It's almost like we need the kind of special purpose vehicle mindset, whether we're focused on a country or a sector. And I wanted to bring in Rachel, because I remember the conversation about when we were putting these public sector pension funds together, there was an opportunity, say particularly in local decarbonisation. I bumped into the very good mayor of Manchester yesterday over in the Action Zone, and we were talking about how he's great desire to do some real local bottom-up infrastructure development and decarbonisation, I guess looking to groups like you for funding. Do you think there's an opportunity to get involved in that space now with the new structure?
Yes, absolutely. And in fact, we have recently done a co-investment in a renewable investment in Sleaford in Lincolnshire, which is one of our partner funds. But I mean, more generally, Border to Coast is investing about $1 billion of our partner funds' assets into infrastructure, a large proportion of which is going into renewable investments. I think the point about carbon footprinting, backward looking, and needing to understand how things actually help with the transition just divesting from a portfolio is absolutely not going to get the capital where it needs to be for us to be able to transition to a low carbon economy. So when we do see some of those pressures, and obviously local government pension scheme experiences those significantly, with it being the largest funded public sector pension fund in the UK, and very transparent with how it deals with things. We have to talk about this is not just about divesting from oil and gas. And if we, over time, as John mentioned, think about we will end up with nothing to invest in.
Yeah, and it is the case, isn't it? The returns have kind of flowed to the commodity stocks in the last 6 months. So that return decarbonisation conundrum is pretty much live there. So we're down to about 3.5 minutes, but I wanted to do a quick rapid fire round. It's a bit similar to the last panel. So we're at COP. Some of you are virtually at COP. You're going to go in there, in the next hour with your sign up, demanding something from the heads of state. What's it going to be? What's the one thing you think will help align the financial sector with this transition? Can I come to you first, Kate? You're Greta Thunberg for an hour. What's it going to be?
Oh dear, what a challenge. I think, well, it's not going to be a placard. Probably it's longer than that. I think we have to accept, though, that the end investor needs to get more information that helps them understand this, because I think when we were looking at the stewardship code applications, and I talked about glossy brochures, you're right, saying to someone, oh, it's going to be carbon free, my carbon free footprint. People want a return on their hard-earned savings, and having come from the asset management world, that's hard to find. And so people have to be realistic about the time and what's involved. And I like the transition. But also, the stewardship code and all the work of the FRC is saying to companies, all parts of the ecosystem, do your bit and take it seriously. This isn't a fringe thing anymore. Yep. This is absolutely front and center of what you do. Whether you think it is or not, it will be in some way part of what you've got to be explaining about what your company does, why it's important, and how it contributes to the targets that we're talking about.
So it's mainstream, be realistic, focus on the transition. That fits on a T-shirt. That's good. John, over to you.
To build on Kate's point, I think that from Vanguard's perspective, we know we have a role to play, and we also know that regulators and policymakers have a role to play, and so we're hopeful for continued kind of clarity on the rules, regulations, rules of the road, so that we can hold our portfolio companies to account for protecting investors by being thoughtful about how they're going to address the risks related to the transition.
Great. Geof?
I guess I'd probably cheat a bit, Claire, and give a two-part answer to one thing. In real world, I would say just, Article 4 of the Paris Agreement, those nationally determined contributions, just, every country strive as hard as you can to ramp those up for the next period of time. My sort of nirvana would be that for things like the hard-to-abate sectors like steel, for example, that carbon pricing would sort of facilitate some of the a speedier transition.
And and I know we took global carbon price kind of nirvana, but I couldn't understand why the G20, if they can set a minimum corporate tax rate, surely they can set a minimum voluntary carbon price, right, as an alignment pool. And just an idea maybe for next year's summit, but it struck me as a bit of a missed opportunity. How about Rachel, your moment in the sun with your COP placard? What are you going to be asking for?
So for me, there's two things. I think that the first is that businesses do better when things aren't uncertain. So I think it's incredibly important we get clear guidelines, clear expectations, clear timelines, ideally, clarity on regulation about what is expected in all sectors. The other piece that I think is incredibly important, something that John talked about earlier, is we are in this together. And therefore, I think it's incredibly important that the developed economies step up and support the developing and emerging economies in achieving this transition as a world together.
Brilliant. And John, this is a great point.
So I would argue for agreed sector transition pathways. I'm going way into the detail here, but if we can get agreed upon sector transition pathways and we can report portfolios against sector pathways, not just at portfolio level carbon intensity, we will have a way to determine whether Geoff's company is doing a better job in their sector or not.
Right.
And that will be a fantastic way to share with our stakeholders and underlying investors. So if we can get consensus on sector transition pathways. That's
That
what I
would be
would
great.
ask.
Well, a great list of really practical solutions. Thank you all so much. That was a really fascinating panel. Thanks a lot.
Thank you.